All right, let's talk about financial charts. Those squiggly lines that can look like pure chaos. Well, today we're diving into how some people try to find meaning in all that madness. They're looking for hidden shapes or patterns that they believe can actually signal what's coming next.
And that really is the million-dollar question, isn't it? Can you really predict where a stock or a currency is headed just by looking at a chart of its past?
Well, for a whole group of traders and analysts, the answer is kind of. They believe the secret is in something called chart patterns. The idea is that these shapes that pop up over and over again aren't just random noise. They're actually visual clues about the market's next move.
Okay, but before we can spot any of these patterns, we've got to understand what makes them in the first place. And at its heart, it all comes down to price action. That's just a fancy way of saying the movement of the price. Think of it like a story. A visual story of a constant tug of war between the buyers, who are trying to pull the price up, and the sellers, who are trying to yank it down.
And you can see that struggle right here. When you see a bullish trend with higher highs and higher lows, that's the buyers winning the fight. They're in control. On the flip side, a bearish trend with lower highs and lower lows, that's the sellers dominating. Understanding this basic language, who's in charge right now, is step one to reading any chart.
So what happens when one side starts to get tired? When a trend starts to run out of steam. That's where our first big category of patterns comes in, reversal patterns. These are the shapes that can hint that the trend might be about to do a complete 180.
Let's talk about a classic, the double top. So imagine the price is climbing. Everything's looking great. It hits a peak, pulls back a bit, and then it tries to rally again. But it just can't get past that first high point. It hits an invisible ceiling and gets rejected for a second time.
So let's break down the anatomy of this thing. First, you get that peak. Then the price pulls back, and that little dip it creates is what traders call the neckline. Then comes that second rally attempt that fails. But here's the key. The real signal for pattern traders is when the price falls and breaks below that neckline. That's the moment they see as confirmation that the sellers have finally taken control.
And this really gets to the psychology behind it. That failure to make a new, higher high is a huge deal. It's like a big flashing sign that the buyers are gassed out. Their momentum is fading, and the whole balance of power in the market could be shifting.
But, trends don't always slam on the brakes and reverse. Sometimes they just pause. They take a little breather. And this brings us to what are called continuation patterns. They often look like the market is coiling up like a spring, just building up energy before it rockets off again in the same direction.
And a perfect example of this is the ascending triangle. You can literally see it form. You can draw a flat, horizontal line across the high points, that's the resistance. And then you can draw a rising diagonal line connecting the low points, that's the support. The price just gets squeezed tighter and tighter between these two lines. And this slide really shows you the battle that's happening inside that triangle. That flat line at the top, that's the sellers holding a firm line, like a shield wall, saying, "You shall not pass." But look at the buyers on that rising support line. They're getting more aggressive, right? They're willing to pay more and more each time. You can just feel that pressure building until eventually something's got to give.
Now, I know this all sounds very clean, very textbook, but here is where we need a big dose of reality, because the real world of charting is almost never this perfect.
And this is maybe the single most important piece of advice from our source material. You have to treat these lines and patterns as approximations. The market is messy, it's human, and imperfect. If you wait around for a picture-perfect pattern to form, well, you're probably going to be waiting forever.
So after all of this, what's the real takeaway? Is that chart patterns aren't some magic crystal ball. What they really are is a way to read the story of the market, that psychological struggle between buyers and sellers. They're meant to be guides, not ironclad guarantees. They highlight moments where the tide might be turning, but they are absolutely not perfect signals.
Which, of course, leaves us with the big question. Are these patterns a genuinely powerful tool for understanding the market and maybe getting an edge? Or are they basically just financial astrology? Just us seeing familiar shapes in the clouds, trying to find order in something that's ultimately random? Well, that's something every person who looks at a chart has to decide for themselves.